Hello, everybody out there in Core Land. I'm going to share my screen and we're going to get this thing kicked off. Wait, that's not the screen I want to share. That's the screen I want to share. So today's topic is the core growth metric. One of the things that we do around here at Core is we listen. And the listening that we've been doing recently has told us that there are a lot of people, clients, business owners that have questions about growth and all the things that go along with that. So we started out trying to get some tools that might help business owners in that situation. And the first we came up with was the core growth metric. So let's get started here. That's me. Exciting. Let's start with putting this in some kind of context, because growth means different things to different businesses and different times of their existence. We have used a separation based upon the growth intent of the company, and that has to do with the company wanting to grow, but also where they are in their business. So the best proxy that we have found, and this is not my idea, this is a scaling up coach out of Texas that came up with this, was to segregate businesses by employee size, because across industries, that's usually a better proxy than just top line revenue or even years in business or profitability. So starting with the beginning of a business, startup, 1 to 5 employees, your primary growth concern is keeping the doors open. It's adding revenue to stay in business, prove the concept, if you will, of the business. A lot of businesses stay here. They reach a point where they're profitable and they've got a viable business and they stay there and they're satisfied with that. But for those that want to grow beyond that, moving into the grow up category of 6 to 15 employees, then the growth question becomes about adding the right type of growth, the right type of revenue. And so the issue shifts to gross margin. So no more taking low margin clients or customers just to get the money in the door and cover the bills. We're now going to be more selective and make sure that we're increasing our gross margin and our bottom line. Then if you want to grow further, going into this scale up mode, 16 employees and beyond, is really more about making sure that not only are you growing with the right revenue, but is it scalable? Do you have the efficiencies in place? Do you have the marketing machine in place? Do you have the right type of capital structure to, say, self-fund this, or do you have to go outside and find additional capital to grow? So this whole conversation in terms of growth is based upon these 3 buckets. We're going to focus for this purpose on the grow up, the 6 to 15, the wanting to grow the right revenue. So let's talk real briefly about the core growth metric components. I'm going to describe these very quickly. Some of you may be familiar with the terms, but just so we're all on the same page. So gross margin, both the percentage and the dollar, are computed by taking your direct costs of delivering that service or delivering that product to your customer. So if you're in a product business, obviously the cost of that product, the inventory, that's going to be there most of the time. There's a labor component. If you're in a service business, then that's probably all that's in there. Of course, all of the employee costs associated with that, benefits, taxes, etc. But basically, if you think about it, is if you're going to bring in another customer, what are your costs going to go up? Those are your direct costs, and taking your revenue minus your direct costs gives you your gross margin or your gross dollar percentage. Lifetime value of a customer is a pretty simple concept. What is a customer or client worth? Sometimes calculating that can be complicated. But if you take it at its basic, and I again use the gross margin instead of the total revenue number, and we'll talk about that in a minute why. But if you take the amount that a customer is going to spend over their lifetime with you, and this is an average, this is not taking this computation by customer or by client, it is the overall average of those. What that gross margin over that lifetime that they're with you. Cost of acquisition is also a pretty basic concept, but calculating it can be difficult depending upon your sales cycle and what your marketing involves. But at its most basic, you could take the amount that you spend on advertising and marketing and the number of new clients or customers that you brought in and dividing those two, and that gives you a cost of acquisition. Break even is an accounting concept where you're basically trying to figure out where your cash flow or profit neutral. So not losing any money, not making any money. So going back to this concept, and a break even, you can use a break even analysis in a variety of different ways, but for our purposes, the reason why we use gross margin is an example. So let's say I have to hire an additional employee to grow my business. And I look at that employee and I look at the costs associated with them. And let's say it's all in, I'm paying them $70,000 plus benefits and taxes. Well, if I go out and get revenue of $70,000 to offset that or break even with that employee cost, what have I done? Well, some would say nothing because you've basically got $70,000 and $70,000 of expense. It's a wash, it's zero, but I'm going to tell you it's actually backwards. You've actually gone backwards because now you're doing more work, you have more employees, and you have the same amount of money. So, basically that's why we use gross margin, is because top line dollar can be very deceptive when it comes to growth. Cash flow versus profitability, there's a lot that goes into this, but understanding the timing differences, basically that's what we're worried about. So depending upon how you bill clients, how you collect on your clients or customers, understanding the impact on that. So if I have a customer that I bring on and my cost of acquisition is equal to the gross margin that I am going to get on that customer in a year, I might look at that and say on a profitability standpoint, that's a good deal. But on a cash flow basis, as we'll see in our example later, it could be that it's negative cash flow throughout that year. And so understanding the timing differences of when that money is going to come in is an important thing besides just the profitability. I'm going to pause here and see if I have any questions. Sorry, I'm here by myself today. So no questions, we're going to move on to an example. So let's say these are your numbers. You have a gross margin of 50%. That's fairly typical in any kind of service industry. Let's say your average annual customer spends $10,000 in gross profit, or $10,000 with you. So your gross margin would be half that. Lifetime value of a customer is $25,000. Cost of acquisition for that client is $7,000, and your current revenue is $500,000. So let's say we want to grow 20%. What does that look like? 20% would equal $100,000 in revenue, so 500,000 times 20%. And based upon our averages, that would equal 10 new clients. So the total cost of acquisition is just those 10 clients times the $7,000 that it takes us on average to bring a client in. So we look at the dollars that those clients are going to bring in of 100,000, and we say, what's our gross margin going to be? Well, 50,000 in this case, 50%. So if we take the 70,000 cost of acquisition and the $50,000 that they're going to pay us in gross margin contribution for the year, that says that, okay, well, we're going to need $20,000 to fund that growth that year. So if you don't have the capital, you're going to have to figure out, do I borrow it? Do I bring in partners, etc. But if you go to that whole cash flow versus profitability thing and get into the details on it, this assumes that you're getting all 10, this computation here assumes that you're getting all those 10 new clients up front. Well, more than likely you're not going to. Those would be spread throughout the year. If you have a seasonal business, they may come in, just in a couple of months. Depending upon your sales cycle, it may be that you're dealing with government entities and you end up with a lot of stuff that's on a June 30th fiscal year and you don't get contracts renewed until July. So it depends upon your business. But if I took this and I just spread them out over the year and said that I was going to get 10 clients equally over the year, and the gross margin then was going to come in throughout the year, but my cost of acquisition, I have to spend that cost of acquisition up front, the marketing dollars to get them. I did the calculation and spared you the Excel spreadsheet here. The net capital, the net cash that you would need in this situation would actually jump from 20,000 to 57,000. So it's very important that you know where your timing of that money is going to come in. So these components bring us to the core growth metric. It's basically two numbers. The first answers the question, how much is it going to cost me to bring in one new client? And it's a simple calculation. It's the cost of acquisition minus the annual gross margin. We've abbreviated it here to CPC, or cost per client. But that's an important number to know. If I want to grow 20% and that means X number of customers, what is that going to cost me? All of this assumes that you're not going to have to make increases in your overhead. You're not going to have to buy new equipment or put on, get larger space or have, additional administrative costs. So assuming that you don't have any changes in those overhead dollars, what's it going to cost me to grow per client? The second question, or the second part of this metric, is the cost of acquisition divided by the annual gross margin. And this tells me how long it's going to take me to get paid back. Why is this important? Well, I think it's key to know this information. How much is it going to cost me to acquire a client, and how long is it going to take me to get my money back? Again, we're using gross margin. We're not looking at top dollars because we don't want to just spin our wheels. We're looking for quality growth here, not just any growth. And so focusing on the gross margin gives us that real growth. And if we look back at our example that we had here, let's just say that we went with the total numbers and we didn't worry about the cash flow aspects of it. We said a $70,000 client or customer to acquire is going to generate $50,000 a year in gross margin. That means essentially that it's going to take us 1.2 years, not on a cash flow basis, but on a just straight profit basis, to get our money back. And that's an important benchmark to look at when you're comparing alternatives. So one of the questions you may end up asking yourself after you do these computations is, does it make sense to grow? Maybe the strategy is, maybe I don't want to market and go acquire those clients. Maybe I want to go acquire competitors. So, the benchmark is a great way to drive alternatives and looking at what your options are. So I am going to end with Q&A and see if anybody has anything that they want to ask me. And if there are no questions, which I do not see, feel free to reach out to me with questions about your individual business. We'd be happy to go through these calculations with you and help you with your numbers so that you can have that information to go and have those conversations with your marketing agency, with your bank, whatever that means. But I think those financial metrics are foundational to be able to go and answer any of the other questions around growth. So until next time, thanks very much. Have an awesome day.